But this is the point in time every year where, you start to get a correction into shoulder season, for thermal coal and for met coal. Restocking is mostly done. So this is the point in time we should expect prices to begin to sort of come off, and they're doing that right now as well. You know, I wrote, in our metallurgical coal outlook, for the coal trader, at thecoaltrader.substack.com, or you can read it at thecoaltrader.com, either one. That I love the movie The Big Short for a lot of reasons. But the first quote in that opens the movie is, it ain't what you don't know that hurts you. It's what you know for sure that just ain't so, right? And and that's kind of what happened to us last year. Like, we knew that we would have a correction into May or June. We knew we had Indian elections. We knew that after that was over, we would see some sort of, uh, you know, restocking activity that would push up prices. And we were even fortunate enough in that transition from May to June to July. I shouldn't say fortunate, but we had the Grosvenor fire in Australia, followed by the Longview fire in the U.S. that took about 6 million tons, 7 million tons out of the market. Um, and traders and everybody got incredibly long at that point in time. But what we didn't know that just wasn't so was that China, which when I was at Woodback, we projected for peak steel in 2024 as far back as 15 years ago. So we know we've known for more than a decade that the pace of growth that China was on in the steel industry was going to peak last year. And instead of peaking in December and then rolling over, it peaked early in the year, and we didn't really get a big push from restocking from them at all. So, everybody got incredibly long post Indian elections, and Indian demand didn't materialize. Everybody got long post the Grosvenor fire, and Chinese demand, Chinese stimulus didn't really materialize. We had a little bit in September, a little bit of a pump fake to get, met markets up there. Thermal markets did fine for the bulk of last year. But after that, just the wheels started to come off on met, and what we all thought was going to be a bearish 2025 because there's more supply coming on for coal. Some of the projects that have been built over the past 4 or 5 years are hitting the market now. Centurion, Peabody Centurion, Warriors Blue Creek is hitting the market. Pembroke, Solid Downs. So there's a whole bunch of supply that's coming, coupled with what we knew was going to be a Chinese slowdown. So how it worked out was that Chinese slowdown got pulled forward into the middle of 2024, and that kind of ruined our ability to get one last big pump out of the met market, and now we're sitting at what I think is looking like the trough of the cycle. We're going to see that here over the course of 2025, maybe a little bit into 2026. If we look at what got us here, which is really the Chinese steel market. Well, Chinese steel bottomed in September. Real estate bottomed last year. Chinese steel producer equities bottomed in September. Hot rolled coil for the U.S. bottomed in July. So the steel space has started to inflect. That's really positive. But now what we have to endure is this rise in supply. Okay, production is heretofore underperformed. Now we're going to get some more tons coming to the market, and for the most part, a lot of these tons are on the met side are higher volatile coals, weaker coking coals comparative to PLV, a lot of semi-soft coking coals, and high vol A, high vol B in the U.S. Those are not coking coals that you build primary blends around. You build them around coals that have really high strength, whether that's premium low vol or premium mid vol, whether you're getting them from the U.S. or from Australia or Canada, or from Russia for that matter. That's really what we need to see in the market. But that high vol component has been so saturated, and there's been so many tons that had been resilient here until now that it started to, blow out relativities. We saw very weak realizations from BTU Shoal Creek. We saw very weak realizations from the development tons that are coming out of Blue Creek on Warriors Coal. Um, and we've just gotten to this part where, we need to either see some of those tons come out of the market. Um, and they did to some degree. Traders who had semi-soft on their books actually dumped it into the thermal market, into the Newcastle thermal market here over the past few months. And so we've seen the Newcastle premium to European thermal coal just evaporate over the course of a couple of months. And so, now we're at a point where supply's got to rationalize. I'd like to see some supply cuts, both on the thermal and on the met side. I think Glencore alluded to that in their call today. So that's kind of what we have to see. We have to see China cut some steel capacity eventually. We've got to see some producers rationalize higher cost production. We're probably going to see another bankruptcy or two in the U.S. of private producers, private higher cost mines that produce these, comparatively weaker coking coals, high vols, those sorts of things. That's got to rationalize before we have a real meaningful turn. And I think we'll see that here over 25 and 26. I think 27 will probably be the first year we're back, kind of on the upcycle for the next go round. Now, I should caveat all that with saying the long-term thesis for coal really hasn't changed. We do have this little bit of new supply coming on right now, but when you start to get into the back half of the decade, we're going to start to see mine depletions, and those aren't insignificant. So there is this, three-headed monster of, peaking China steel demand and rolling over with a growing India. We have yet to see a European recovery. I think we will. We're about ready to end the Russia-Ukraine war. I think Russia will be a positive, or Ukraine will be a positive inflection. We're going to have to rebuild the country. Steel is going to play some role in it. They're going to need power. So I think you might see some new coal plants built. Domestic U.S. thermal coal is probably going to have a decent year with all the power demand that we have. So there, even amidst all the bearishness, there's still some pretty positive narratives. I think even for this year, and then over the longer term, really not much has changed. By the time we get to 2030, and you start looking at supply versus demand, we move back into deficit here in the back half of the decade as well. Is it going to be as generational an upswing as we saw from COVID to, the Russia-Ukraine war? No, it's going to be that. But, I think a lot of these companies that, ran from, single digits up to, mid triple digits and then have corrected by 60% since, I think we'll see some doubles and triples on those as we get into 27 and 28. So for me, I kind of want to think about, starting to, size up coal a little bit toward the end of this year, toward the middle of next year, probably Q2 next year. I think I'd like to be pretty full size, maybe not as overweight as I was back in 21, but starting to get to the point where I think we'll have a pretty good future in front of us. Hope that all makes sense. I mean, this is a huge can of worms to open up and try to unpack.